The greatest investor of all time is none other than Warren Buffett. It would be worth more than $30 million today if you had invested $1,000 in his investment company when it was founded. How did Warren Buffett manage to get such a high rate of return? The explanation is that he grasps what most people miss and adheres to a handful of fundamental concepts that anyone may apply to their daily lives. You'll learn them all by the end of this video, so keep watching. Welcome to Empire Investing, the channel for aspiring millionaires and billionaires. If this is your first time watching our channel, please consider subscribing to see more videos just like this. And with that, let's get started.
We look for three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity.
If they don't have the latter, the first two will kill you, because if you're going to get somebody without integrity, you want them lazy and dumb. I mean, yeah, you don't want too smart and energetic. So the answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year. I'm going to make more money this year. So this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money. So I'm going to go in this year's. They're always looking in the rear view mirror. And when they look in the rear view mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rear view mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's astounding, but that's what makes for a huge opportunity, just huge opportunity. I've been instructed by Ben Graham to use a quantitative approach while purchasing goods and services. I went around hunting for what I term quote-unquote cigar butts of stocks because that's what I was taught in 1949, or because it made a significant impression on me. You wander down the street looking for cigarette butts and you come upon this soggy, ugly-looking cigar. The cigar butt technique to stock buying is similar to this. Pick it up and you get your one remaining puff. You throw it away because it's disgusting. Nevertheless, it's free or cheap and you seek for another soggy one-puff cigarette. That's exactly what I did for years, and it was a huge oversight. Despite the fact that you can earn a living doing it, you will not be able to succeed financially. It's a lot easier to buy a great firm than to start one from scratch. In other words, I'd rather acquire a great company at an upright price than an upright company at a great price. However, I am of the old school and believe that I can only expect to make money from things that I fully comprehend, and by that, I do not mean that I fully comprehend how the product works. I'm referring to having a clear picture of where the company's finances will be in 10 or 20 years. Wrigley's Chewing Gum's economics tell me that it will look like in 10 years. There is nothing that the internet can do to change the way people chew gum or the gum they choose to eat. If you've got Double Mint, Spearmint, and Juicy Fruit, those brands will be around in 10 years' time if you own the chewing gum market. The figures on Wrigley aren't going to be precisely what I expect, but I'm not going to err on the side of caution by anticipating them. It falls within my circle of competence to evaluate this particular company. What they do, how they make money, and how they compete are all things I know well. My worst mistakes have been omissions rather than commissions. I'm talking about the things I was capable of handling. None of them were beyond my area of expertise, and I was sucking my thumb. Those are the ones that really sting. They're nowhere to be found. There is a good chance Berkshire paid at least $5 billion or close to that for sucking my thumb 20 years ago or so. We bought Fannie Mae for nearly nothing. Microsoft isn't in my circle of competence, so I don't have any reason to think I'm entitled to get money from Microsoft or from cocoa beans or anything else. I don't care about that. The problem is that I know enough about Fannie Mae to get it wrong. Conventional accounting does not reflect that. There is no doubt in my mind that it would have been a huge mistake for me to have taken it, and I've had plenty of those. So long as I resist the need to include them in the yearly report, you won't know about them. Unless I mention them in the yearly report, you won't be aware of their existence, as they don't appear under the typical county heading. Omission, on the other hand, is far more significant than commission. Life is full with significant chances that must be taken advantage of. Because we do so few things, we must seize the opportunity to do something large and right when it presents itself. A small-scale effort can be just as disastrous as not attempting it at all. If you don't seize the moment, you'll miss out on a lot of fantastic chances. A 20-putt punch card would be ideal for you after you leave school here so that you may use up a punch for every financial decision you make. You become extremely wealthy as a result of your meticulous planning on every single one. You were at a cocktail party when someone mentioned a corporation whose name you couldn't even pronounce or understand. Despite this, they made some money last week on a similar one. Having only 20 punches on the card would discourage you from purchasing it. We will not sell our wholly owned business to anyone, regardless of how much they offer. The Buffalo News Borschium's candy, whatever it may be, to see if we are offered 3 times its value, we won't sell it. I may be wrong, but I know I'm not incorrect if I buy 100 Berkshire shares because that's how I want to live my life. All I need is a change in the newspaper, an obituary, and the amount of money my foundation has, and the break-off ties with individuals I admire, and those who have joined me because they believe it's a permanent home. The mere fact that somebody has waved a big check at me is enough to prompt me to do this. It would be like selling one of my children for a large sum of money, so I won't do it. And I'd like to assure my colleagues that I will not do so lest they be disappointed in me. We tend not to sell stocks unless we become disillusioned with the management or believe that the economic characteristics of the company have changed significantly, which is the case with more and more of the stocks in question. However, if we were chronically short of funds and all kinds of opportunities were available, we might take a different approach. We're not going to sell though, merely because the price appears to be too high. Let's head over there now. Hello, Mr. Buffett. I've got 2 short questions. One is, how do you find intrinsic value in a company? Well, intrinsic value is the figure you'd get if you had perfect foresight into the future and could foresee how much money a company will hand you up until the end of time. The intrinsic value of a company can be calculated using the right discount rate. To put it in another way, the sole purpose of making investments and putting money aside now is to reap the financial benefits afterwards, right? That is the essence of investing. Now, if you look at a stock or a bond, assuming it's a United States government bond, it's very clear what you'll get back. Exactly when you'll receive interest payments and principal is specified right there on the bond. As a result, the value of a bond can change at any time if interest rates rise or fall. The cash flows, on the other hand, are not printed on a stock certificate if they are on the bond. What the analyst does is print out a new stock certificate representing an ownership stake in the company, convert it to a new bond, and state, "This is what I believe it will pay out in the future." Our purchasing decisions are based on the fact that we are thinking about Shaw's new carpet-making machine when doing so, and you all learned this in business school. Even so, for a large company like Coca-Cola, the market value of the company today is somewhere between $100 billion and $150 billion. In fact, if you had $110 or $15 billion, you wouldn't be listening to me, but rather I'd be listening to you. Is it worth it to pay today for what the Coca-Cola company will provide you with in the next 2 or 3 centuries? In the long run, it doesn't really matter what the discount rate is. How much money are they going to give you as a reward? Isn't it a matter of how many analysts will recommend this product, or how much volume there is in the stock, or how the chart looks? It all boils down to how much money you can make off of it. That is the only reason, regardless of whether you are purchasing a farm or an apartment building. You're investing now in order to reap rewards in the future, whether it's a financial asset or oil in the ground. How much money are you going to get, and when will you get it, and just how certain are you? In addition, I consider these factors when determining a company's intrinsic value, whether we're purchasing the entirety of a company or just a small portion of it. It's my approach to think that we're buying the whole business. There is a lot of uncertainty about the outcome of this business venture. Of course, you want them to be able to use the money they make and increase their returns over time. Although Berkshire has never paid a dividend, the value of the businesses it owns has grown, which means that it has greater ability to distribute dividends to shareholders in the future. Real question is, can we deliver enough cash to you fast enough to make it financially prudent to lay that cash down at today's interest rates, assuming Berkshire is selling for, say, $105 billion or so now? And that's the crux of the matter. You will not be able to purchase the stock if you cannot answer that question. Stocks can be gambled on, or your neighbors can buy them if you don't want to. For internet companies, for example, I'm unable to answer that question because there are just so many of them. There are a lot of companies I can't answer this question for, but I simply avoid them. That's all for today. What do you think about Warren Buffett's 7 rules to success? Join the discussion in the comments below. If you like the video, please click the like and subscribe button. We'll see you guys in the next video.